Let's ask Cheryl Young, private wealth advisor for the Rockefeller Family Office, out here from the West Coast. It's great to see you in person. Is that what this move in the market today, do you feel, is about? Hopes of debt ceiling deal?
Absolutely. I think everyone is really realizing that the politicians cannot commit political suicide. There is probably going to be an agreement reached fairly soon. And we view this as, even if there's short-term volatility, a buying opportunity if there is more volatility. Hopefully this is the end of it, but we still have another 2 weeks to go.
Yeah, what about that question I asked at the very top here, whether we can finally get out of this range? We've been looking at, what are the potential catalysts for that? Is this one?
I think maybe not yet. I would love to be more optimistic. The S&P is exactly where it was at in April 2021, so we are 2 years in a sideways market.
We're tired of being in a sideways market.
Trust me, my clients are definitely tired of being in a sideways market as well.
I bet.
But I think this is a market where you have to be very selective, very patient, very defensive, which is exactly what our Chief Investment Officer, Jimmy Chang, just reiterated to me this morning. I think there's going to be breakout in certain sectors, in certain names, but the broad market, I think there's still some pain potentially ahead.
Does the fact that we've been narrow in terms of Megacap leadership, does that make you more cautious than not? Is it a negative sign to you?
Absolutely. This is the most narrow range we've ever seen in stocks. If you take the top 10 mega caps on the S&P 500, they account for 95% of the returns year to date. If you take the top 5 names, it's 75% of the returns on the S&P year to date. If you look at an equal weighted index, which, by the way, this week marks the 20-year anniversary of an equal weighted index ETF being launched, it's negative 0.17 as of just a few minutes ago year to date. And so we're really seeing a few stocks move and drive the market momentum, but it causes us a lot of concern that the rest of the markets have not rallied with these big mega cap names.
I do hear both sides of that debate, though, that it's not necessarily as negative as some would want to point out. Those stocks are carrying the market. They are the biggest by market cap for a variety of reasons that they've been going up. And we talk about it: earnings power, balance sheet, cash flow, et cetera. AI.
We love AI. Yes.
So maybe does it necessarily have to be as negative as some would project that it is?
I hope not. Look, I've been a lot more positive. As you know, the last time I was on the show was in January, and I said this was a time in January to double down on these mega cap names. Mm-hmm. So I am still a believer. I'm in Silicon Valley. I have clients who work for these companies, and these clients are wicked smart people, and I know the things that they're doing. We see some of the advancement in AI. I know this is all over the news right now with the Congress testimony yesterday by Sam Altman and several of his peers. I think there are a lot of areas that have upside ahead, especially in the technology sector. But what worries me, we have an M2 money supply that has declined year over year. 4.1% was the reading in March. We have the commercial real estate market, which everyone's been talking about this as well, but we have over $1 trillion coming due in adjustable rate mortgages in the next year, and that's going to start hitting the market with rates up over 500 basis points. Mm-hmm. So I don't think we're out of the woods yet in terms of potentially still going into recession. However, I still think this is the time to own stocks. I would be adding defense, maybe add some puts to your portfolio to protect the downside, but that will allow someone to stay invested. And what I'm advising my clients to do is to stay invested for the long haul. You shouldn't be in stocks anyways if it's short term, but be very selective about the names you're choosing. You said you're out in Silicon Valley. I mean, the epicenter of the regional bank issues when they started anyway with SVB. Yes.
Do you think there's more significant issues to come as it relates to the banks?
Look, I hope not. The banks are very well capitalized, and we have been referring this. The large banks are. We have seen what I will refer to as a walk away from banks, where deposits have been leaving the smaller regional banks and really flooding to the larger banks. Mm-hmm. I know my office has been opening up a lot of accounts for treasuries over the last few weeks because clients are looking for safe haven away from just deposits at some of the smaller banks. So it is a concern, and especially around some of the clients that worked with Silicon Valley Bank, these companies were depending not just on their deposits, which have been shored up, but also for loans and lines of credit over the next year. And that's an area where, again, on the private equity space that you have to watch.